Warm welcome to my colleagues. We're this is a really relevant and topical discussion, and we meet often, at least every second month, as our BC Tech CFO Council. And financing during these challenging times is in managing capital and runway and cash flow is just is really an area of focus for our group and for every company. I'd like to welcome everyone. See a few friendly faces out there. Dean Chamberlain from RBC and their capital markets group or debt financing. So that's good to have you here, Dean, and others. Please, we want to make this as collaborative as possible, and also want to have as much interaction and questions from everyone on there. So we have a varied audience. Please, through the chat, please submit any questions you might have, and look forward to addressing them. Before I pass it on to my colleagues on the panel, I just had a couple just observations, I think. And if I look at, it's an interesting time right now for just companies in general, especially technology companies. If we look what's happened, and it's really in somewhat surprising, somewhat not, but the last 2 years have been impacted by this global pandemic of COVID. And we've also had some geographical and geopolitical economic challenges, particularly in Europe and Asia, where their free trade is really, barriers have gone up. And UK reverting from Brexit as well. And if you look at all these things, usually you would think that would have a down cycle and tightening of capital. But because of the pandemic, a lot of governments inserted a lot of liquidity into their systems. And that resulted in very robust and unexpectedly capital markets, not only in the stock markets, but a significant availability of capital to companies that may not have had that access to capital previously. If you look at the 10 years before, and our last real credit crunch was probably the 2008 financial crisis. But since that period, we've only had a small handful of public technology IPOs in Canada. One of them is Shopify, which became our biggest market cap company. But it was really tough, and that illustrates, and Lightspeed out of Montreal, very solid, good, large companies, where they had difficulty initially going public. And then all of a sudden you go into COVID and everything's batten down the hatches, we're working remotely, and then all of a sudden capital is available to everyone. You see almost every week, you have the SPACs in the US that have hundreds of millions looking literally for something to invest in. And in Canada, we had a lot of RTOs on the venture, on the public markets, IPOs, and then a lot of capital being injected in private companies. And candidly, the valuations were pretty generous, and especially if we look back now. And now what's happened really the last 6 to 8 months, the tap has turned off. And if we look at some of those companies that got capital, and a lot of capital, very robust valuations, they would have been very challenged likely to have received those valuations, especially in the 10-year period, competing for capital to go public like Shopify. So if we look at now, it's almost like the pendulum swung just as much to override that, and now it's incredibly tough. The capital markets are challenged. It's tight. The debt and credit markets are tight, and really there's a lack of liquidity available. If we almost parallel this, it's almost like similar to the dot-com. And then I'll show my age, and maybe with George and a few others veterans here. But I mean, in the dot-coms, there was just so much capital that came, and a lot of it is on back of ERP, the Y2K, real changing impact of technology, operational efficiency from wireless plays and other companies. And so, but what happened, there's a lot of capital thrown at ideas. Now, good companies with solid business plans, and I think that's really relevant here, should survive and should prosper. If you look at Amazon, I mean, they were kind of not even, building an electronic railway to ship books, physical items in an industry was kind of, unusual. But now look what they built and look at how they've survived, and they had to manage their cash and runway, and they went from zero to hero. And so if you look at today, I think if the companies that capitalized and took advantage of strong valuations and generous terms and access to capital and padded their bank account to support their business plan execution, I think they're probably in good shape. But there's a lot of companies that maybe looked at it and said, well, maybe we can do better. Maybe the terms could be better, and maybe didn't capitalize. And now they may, there's a lot of companies that may have to deal with what they have. I'm from Winnipeg, so you need wood. It's sort of the parallel is if you didn't cut wood in the fall, it's a long winter. And don't ask your neighbors for wood, even though they're nice in Winnipeg, they probably would share. But anyways, so you have to manage with what you have. And if you look at the equity markets being quite challenged currently, there's other exciting, potentially innovative as well of capitalization structures coming, in addition to traditional debt, sub-debt, convertible debt. We'll talk about some of it from some of my colleagues, but SaaS revenue, multiples of that, royalty revenue structures. So companies and lenders are that maybe are equity focused are looking at how they can, create an opportunity to leverage the strengths of a company. However, the cost of debt is very high in this environment. And so, you can argue that the weighted average cost of capital of equity is higher, but really you don't have the cash outflows or the necessity for predictable cash flows to service that debt and to manage through that. And so you got to balance that, especially with the increased inflation as well. If we look at a short-term outlook, and we'll talk about that later, really we're candidly in a recession. We need to all batten down the hatches and get our businesses to do more with less and really stand on our 2 feet. It's a bit of the Jimmy Pattison school of business, which is, why don't you do this cool thing, like sell a lot of stuff, make some money, pad the balance sheet, there we go. And it's really technology companies are balanced because we're a lot of times in an early stage where we have to invest before the cash flows come. So that's the balance of managing that timing. And it's challenging for early stage, but it probably will get worse for a while before it gets better. So, really that lines into, and we'll talk about prudent, tight cost management. And candidly, I have this discussion a lot, and part of it's what doesn't kill you makes you stronger in some of my experiences and with my colleagues, but it's tough, especially if you look at, say, everyone's going to say, we can't do without that. We can't do without that. And it's amazing what you can do with it once you're forced to do with it later on. So my personal experience is really focus on what your core strengths are, what makes you really valuable, important as a business, what you do and why it matters, and really try to get rid of everything else. The more you cut now, the more flexibility you will have in your business and with your financial partners, whether it's debt or equity, to get through tough times if your revenue and cash flows don't materialize. And remember, those are the things outside your control. So be very challenged on that, because even good companies that have strong revenue streams and cash flows, like Meta, like Amazon and Twitter, even though that's kind of an interesting scene right now. But Elon is really trying to say, listen, Twitter can, as a large tech company, and those big tech companies are all watching him and saying, can you cut your staff by half of your costs and actually maintain your operations and do better? He's being extreme in it. And you never want to throw babies out of bathwaters, which is the nuance. But if you look at, the offsetting thing is really, as we transition out of COVID, we've got pent up spending, travel to trade shows, to customers. People want to be in person now. So that's almost counterintuitive to battening down the hatches. So real balancing. And like I say, some of it is really, your core strengths, your products, your tactical marketing, and really run G&A as, hot as you can without being penny smart, pound foolish. And the balance between really being managing short-term preservation and runway and living to fight another day. And not just for survival, because you can't cut to success. You have to balance between investment going forward and versus strategic investment. But you have to really ask yourself, even though it's great, how important is it to invest in that next initiative versus the current one? I've got a couple of stories here that are real, and you may be aware of them, but I took a company called Pivotal public. We're in the CRM space, went public on NASDAQ, went from 100 to 1,000 staff and 10 million to 150 in 3 years of revenue. And then 9/11 hit. And then all of a sudden, boom, right? No one was buying perpetual software. And it's interesting because we were in the mid-market, and we were looking at launching, in those days called ASP, application service provider, but it's a SaaS model. And we were saying, okay, we had servers in our new office building with T1s and those, which were really fast. But anyways, the net of it is we had that whole mid-market SaaS offering. And I remember there's a new company that came out, and we're saying they have no functionality, their pricing's expensive, their SaaS. It's a company called Salesforce. And we're saying, well, they won't be successful. We have more. We're actually gonna launch our own. And it's interesting, when 9/11 hit and our perpetual software model didn't really scale because everyone stopped spending, we went from 1,000 staff to 700 in a week, and trying to batten down the hatches and really go. And we said, okay, we will launch that SaaS offering later on. Let's get through this. And it was tough because the cycle went. And we missed that strategic opportunity to frankly be Salesforce, and there have been executions, but we were well positioned, especially being, second largest reseller of Microsoft Embedded SQL with them. And so in the mid-market. But the point of that story is we look back and say, when do you invest and when do you not? Because that would have been prudent. But listen, our revenues went from 150 down to 80. Instantaneously overnight. So you've got some challenges. Some other things to talk about is, I was with a company called Infowave, and we had cutting edge wireless technology. Challenges, after 9/11, no one was buying wireless technology. They invested in all their ERP and new systems. And even though wireless was really going to unlock the value, it was really tough. And this ties into financing catalysts during tough times. And one of the things we used effectively was M&A. We didn't have access to financing independently of the company. We're burning capital, really great technology, but we had a couple of M&A transactions which have to be strategic. They have to make financial sense. But as a result, we bought a workforce management solution. Now all of a sudden, our wireless solution bundled with that, and we were able to get capital with some strategic capital and financial capital, and that really helped us, do those transactions. So look where there could be some strategic biz dev that makes sense, that enhance your value, because we are quite a narrow solution, very good, but narrow. Final story I'll talk about it before I pass it on is my last company before, Tantalus is Intrinsic. And when I joined, it was just, they'd raised 100 million. They were doing a wireless operating system and very, a public company, and they were burning 5 million a quarter US. And that's okay when you're investment. We just signed some OEM deals, kind of the Intel model. But then the financial crisis hit in 2008, and you couldn't raise any more capital. We need to execute that plan. We were checked out in the market for a couple of things, Android free from Google, and we had a turn-by-turn solution. But those things happen in our industry. And so we had over 600 employees. And then we looked at, what do we do? I had to go around personally, to Beijing, to Israel, to the States, Cupertino, and really shrink our pattern. But then we looked at, how can you generate non-dilutive capital? We took our engineers and said, okay, rather than building product internally, and this is a balancing act. We said, okay, we're going to charge them out. And we became a product design house for a temporary period. We built the Nook for Barnes & Noble. That was a multi-million dollar, service engagement, really. We leveraged our technology and bundled it, but that brought us cash flow while we were trying to figure out how to right-size, restructure the business, and bought us some runway. So look for things that you may be able to leverage. Now, the challenge is we weren't going to be a service company because we need eventually to productize, and that allowed us the time to partner with Qualcomm, build IoT engines and products. And then we scaled our business back up to, from restart to over 50 million US. And we were acquired just at COVID started by Lantronix, a NASDAQ company, successful exit. So, look for opportunities in these situations. It's a bit of deja vu from the .com. and then also even from the '08, but it's tough. So plan for the downside, manage the upside, and without throwing babies out with bathwaters or being penny smart, pound foolish. Because remember, we're all building in a business. So you got to be a little defensive now, but you still got to be around to grow and build something you're proud of. So with that, I think I'll throw it over to you, Shannon, and welcome. We're really blessed, and my colleagues have a wealth of experience, and look forward to hearing from them. So Shannon.
Hi, everybody. So I'm coming to the conversation from the perspective of early stage and smaller startups is really what I'm going to offer. And there's a couple of things that I've observed. One lesson and two observations that I'm seeing more of. I don't know if it's circumstances with who I'm connected to or what have you, but the one thing that that I have learned or relearning of recent time is that when smaller and early stage companies are getting ready to raise capital, they internally prepare. They get their data room, they get their financial model, they sound off with the board, they get their inside house ready to go out to the market. What I am relearning or being reminded of is companies in those stages, what they haven't done is they haven't gone out into the market to stress test and understand what exactly, if for example you're trying to raise a Series A, what are the metrics and mechanics that the various VCs that you may be talking to, what is it that they need in order for them to cut the check? So it's not only the internal preparedness that you want to get ready, but you want to stress test that with third parties just to make sure you get it right. So that's been a bit of a reminder for companies, and sort of as we talk to them within Foresight to go through that, because your revenues might not be high enough, or you might not have the right SaaS metrics at a certain threshold. You need to understand what it's going to take to sort of for them to write that check. So that's one of the lessons. The other two observations that I have into play is, we know sometimes founders go through some changes where they change out of the company, or there could be a couple of co-founders where they have changes. And I find a couple of situations in the community where those co-founders or CEO don't have specific agreements in place to sort of deal with changes in conflict or different directions that the company might be doing. And so I'm seeing some of those present themselves, and sometimes they are being resolved in a good way. Sure, there's always some bruised ego in play there, but what I'm noticing is the ones that other ones that I'm seeing is there's a lot of potential high conflict situation. So getting those understandings either through your co-founders or the CEO, what a transition would look like while everybody is of clear mind and on reasonably good terms, what that could look like. And related to that, but similar, is the other observation that I see out there is as companies, particularly early stage and smaller companies, evolve to the next levels or next stages, is even at the board level, people sometimes bring on board members that they're familiar with, but may not be able to elevate the company to the next stage. And so where we look at CEOs, sometimes there's changes with co-founders of CEOs. Sometimes there needs to be changes with board members as well. And so having those sort of open discussions and getting agreements and information in place so that it's a much smoother transition and easier on everybody is really important. So not only do you need to be prepared internally within your organization as you get ready to raise capital and go out there, but you need to stress test that externally. but just don't forget some basic housekeeping items about, when there are changes either at the co-founders or C-suite, or the CEO or board member, you should have things in place in order to make sure that those things happened with, the maximum amount of success. There's somebody had told me this one expression, and I really like it. You may be passionate and believe in the vision, but how you get there, don't be married to it. So when there are changes, keep that in mind and get things in place to make sure things happen, smoothly. And that's those are some of my lessons and observations that I'm just seeing right now.
Well, thanks so much, Shannon. I look forward to getting a little bit more in the Q&A when we look at that, but really appreciate that because it's very relevant in this day and age. Jonathan, look forward to hearing from you, and you're managing both the financial and the operational side as COO there, which is a really good blend and important, especially when you have to navigate through an environment like today.
Yeah, it's been interesting. Thanks. Maybe I'll just give a bit of background on the company that I work with, iNetco. We've been early stage startup company, but we've been a startup for quite a while. We started originally in 1983 and then recapitalized in 2008. And we work in the bank payment space. I like to refer to ourselves as the Rosetta Stone of the payment protocols, because we can speak no matter what payment language it is. We can do it in one single unified record, one transaction, all in one language. And we originally started in 2008 doing transaction monitoring and analytics for banks. But it was a nice to have, and it wasn't a need to have. It wasn't a significant game changer, but it allowed us to develop a significant understanding of the payment space. And what happened was, as we're developing our core technology, we launched in 2020, at the end of 2020, iNetco Bullseye, and that is our fraud prevention and detection platform. So if you tap your credit card at a Starbucks before it goes back to authorization, we will have actually interrogated that transaction for machine learning to determine if there's anything fraudulent about it, and then can stop that individual transaction rather than shutting down a significant array of transactions. So lower false positives and better return for your customers and for our customers, the banks and their customers. But it was that kind of moved us from a nice to have to a need to have, because the fraud prevention has got a much better ROI. People know what their fraud losses are, whereas if it's a customer being upset, they may not know that. And so that's where we started to actually have some rubber hit the road and started to raise money. But unfortunately, that happened at the same time that COVID came, and then now the economic downturn. And we've historically been financed through angel investors. And that's taught us to be extremely capital efficient, both in good times and bad times. But it also taught us the importance of working relationships for non-dilutive financing. And one of those relationships was by leveraging our existing IRAP and SHRED relationships. We were actually invited to be part of, it's called AGS, Accelerated Growth Services. And it's an umbrella organization within the government that connects you with all of the various sources of funding as well as opportunities within the government. But they set up the meeting, and then it really came down to us to make sure that we maintain those relationships, maintain those touch points with those government organizations. And so we would add them to shareholder updates, we would have quarterly calls with them, and we would be proactive in terms of asking for assistance, whether it was if we needed to have a trade commissioner touch point in Malaysia, finding out who that would be and then setting up a friendly call. And that really resulted in developing a strong working relationship with AGS, and it ultimately resulted in us receiving an invitation to apply for non-dilutive interest-free financing, and we were successful in that, and ended up being the largest grant out of that entire allocation. So it just kind of speaks to the needing to work those relationships, regardless of whether you're in need of financing at that time or not. Given the fact that we've moved into the fraud space, obviously the macroeconomics have pulled back significantly, But when you look at fraud prevention, that's actually a growing industry because it's only going to be increasing just as digitization of transactions comes on, as well as smaller IT teams result in more bottlenecks, more potential for fraud to occur. And so we're trying to raise money right now in where the broader economic macro environment is quite poor. So it requires us to communicate to our shareholders as well as our potential investors more about the market. So about the market that we play in rather than the overall market. And that's where when we were trying to do a larger raise on the back of the release of our Neco Bullseye, where some of our KPIs weren't in line with what the investing market wanted. So we historically would sell enterprise licenses, so we get this big cash up front, and then support and maintenance on the back end in the future years. When we were speaking with our bankers, it was much more about SaaS because that attracts a higher revenue multiple, also more predictable cash flow stream. But converting over from a enterprise license model to a SaaS model is extremely challenging because you're giving up that like crack cocaine of big cash influxes to having to balance your payables, balance your cash flows while you start to build up your term revenue and then start to have that in. Once it's in, it's fantastic, but that split point is extremely challenging. And that's where it really came to us to have very strong conversations, making sure that we're consistent on our messaging with our investors, with our potential bankers, because we will talk with people 6 months, we'll have conversations, and they want to talk to us in 6 months. And what you're saying 6 months ago has to be what you're doing in the future. Obviously, you can't predict everything, but you need to have a strong vision that's something you can actually execute on. And the other thing was just when we moved over to SaaS, we also had the opportunity to invest more into our services businesses. And it's a challenging balance because you're balancing between wanting to look like a SaaS software business, but at the same time, you can't ignore the fact that you could generate a significant amount of services revenue. And so that's just something that we were always balancing, is to make sure that we're still ultimately walking the message that we were talking and still just following through. The other things I just wanted to touch on was just given the fact that we are requiring growth capital, and obviously a lot of people are sitting on the sidelines, but they still have dry powder. We're looking at other opportunities in regards to debt deals, as well as the potential of a down round. And that's just it's a balancing act that you have to calculate to say what is the outcome if you did a down round and you were able to actually invest in sales and marketing and then generate a higher revenue down the road. Is that better off? But what we're ending up doing is leveraging a lot of what our business has grown into, and so we're starting to look at SaaS-based lending when we start to build up our SaaS revenue stream, but then also just making sure that our business is as efficient from a cash flow perspective as possible. So leveraging our partner model where we don't have to have the same headcount that is historically needed if you had a sales team, and using that partner model to do a lot of your ground sales team. It requires a lot more communication, a lot more management of your partner model teams, but it has been very effective for us to maintain growth while being cash flow consistent. And it's just that balance between growth and dilution that is something that we're always kind of working on. But for us, it's just that constant communication, both with all of our stakeholders, be it investors, vendors, customers, as well as our employees and future investors. Maybe we'll pass it back to George now.
No, Jonathan, some really relevant, a lot of meat from both you and Shannon. Thank you. Couple thoughts, and it's always challenging when you look at maybe a down round, but then if you look, it's really, if you take a step back, but move several steps forward, because the challenge of not having capital to drive your what you need to do to capitalize, especially when you're in a growth environment of an opportunity like that is probably recession proof, like fraud probably is. So it's that. And then the importance of non-dilutive financings especially that are potentially available for government. I just wanted to highlight one other one that could be a real ally to us that, and at that, I noticed that Raul Duke is on the line, which is wonderful. And EDC Export Development Canada can be a very strong partner, not only from ensuring your AR, so you get 90% and quick turns and accelerate cash flow, but their mandate really is to help support companies, not only from financial support and capital, but guarantees of AR and other programs, and helping Canadian companies leverage their IP, particularly out of Canada. So, great, a lot of good points to highlight there. And, Raul and his team at EDC are great to work with, and very focused on how they can support you with helping you getting the capital you need. Last but not least, we have George Lawton, who brings a wealth of experience, CFO and operational manager. So, George, love to hear your thoughts.
Thanks, George. And welcome to everybody. In terms of what I'm looking or focus on here is more of the mature companies and the traditional financing. But to George's point, I've been around the block a few times, went through the dot bomb, went through the 2008 financing debacle. And yeah, I've been in public and private and had to raise debt and then settle it at a discount, which is always fun. And of course, built organizations, or at least helped grow organizations so that they can deal with Plan B. I was in an organization in the early 2000s. We had a relatively large workforce, and the industry fell apart, and we had to do something about it. And basically, we decided on having core permanent staff, and everybody else was subcontracted. And it allowed us to flex with the business, which really helped us get through that particular time frame. So yes, plan for the downside, but manage the upside carefully, as George said. In terms of mature tech service companies, I've got 2 of them, and within my portfolio, and both of them are facing the same thing. They've established the business, they've got a bunch of customers, they've got strong AR, and it's really easy for them to approach the financial institutions, the banks, etc., and to get operating lines. And I can't stress enough the importance of an operating line. If you can get one and hold on to it as long as you can. It really helps. One of the tech services companies early on didn't have an operating line. They had to do a call to the shareholders to invest some funds to get over a temporary blip. We're now in the process of securing $500,000 in operating line, and that's going to keep them. That's going to manage the dips in their cash flow cycle. So really can't stress enough getting an operating line. Operating lines also help you in terms of hedging with Forex, because you can use them for that. You can use them for letters of credit. You can use them for corporate Visa cards or corporate credit cards. And you can also use them for electronic banking. A lot of the banks, when you sign up for EFT, there's a delay. There's a 2-day, you always have to manage this damn 2-day period. If you have an operating line in place, most banks will give you same-day EFTs. One, it helps you manage your cash flow because you know when it's going through the bank account, and it makes it easier. Writing checks is expensive. Trust me. In terms of other types of financing, the organization that I have up here, we have done 5 acquisitions in the last 5 years. We did 2 during COVID, small tuck under, these service organizations that were created and were basically sole practitioners and had grown to a fairly modest size. COVID was great for us. It gave everybody the opportunity to look at their lives and go, hey, I don't want to do this for the rest of my life, so let me sell. And we were all too grateful. And of course, to do those acquisitions, we have a single shareholder. He doesn't have a ton of money lying around. So, you know, we approached BDC, got some sub debt. They're really helpful. They're flexible. They're expensive, but they get the job done. And so we use that extensively. Other types of financing, you know, Jonathan talked about SaaS. If you've got regular revenue streams, something that came out of the mining industry was to monetize those revenue streams, finance against those. An interesting thing, it's fairly new in the marketplace. Shannon reminded me yesterday that there's a new player on the market who's offering IP-based financing. They'll give you money in based on your IP, which is great for tech companies. One of my other clients is a long-time startup company, got extensive IP, and that could be an option. So I'll talk to the CEO next week. But one of the things that I brought from my prior experience in these large public companies is, if you've got assets, leverage them. I worked for a bunch of companies that had extensive real estate holdings. We leveraged those. We got significant debt. It is cheaper than equity, George, but it does bring a bunch of complications to the game. Managing the covenants on a quarterly basis is tricky. Having to ask for waivers or relief letters is never a nice thing to do. My recommendation is keep your forecasts up to date. If you're ever going to blow your covenants, talk to your financial institutions before you blow them. It's always a much easier conversation before the end of the quarter than it is after the end of the quarter. But yeah, just keep an eye on that. And then, you know, from an outlook point of view, one of my clients is a real estate developer. We've been raising money for a couple of years on from wealthy individuals. Interestingly, very recently, you know, early fall, the uncertainty in the economic market was playing a big part. Our incoming financing slowed down to a trickle. What's been interesting over the last couple of weeks is it's ramped back up again. And we're back up to raising the same kind of money as quickly as we were previously based on real estate assets. So I think, you know, from an outlook perspective, especially in Canada, people are feeling a bit more comfortable and less uncertain about the future. So I think, I'm hoping and I believe that the cash taps will start to open up again. George?
Well, thank you, George. I mean, really relevant and important, informative comments there. I think we're all with you. We hope that the tap comes and fosters some economic investment. A couple of things to highlight is, first of all, you're absolutely right. I mean, it really assess the stage of company you're in. Early stage company, I mean, equity is, as George said, is very expensive, but it's manageable and more manageable, sorry. If you're early stage in your investment, you know, dealing with covenants and cash flow requirements, liquidity ratios may be more challenging, but that goes to the next one. If you're more mature, and like the Answer company or other companies, and ourselves included, at Tantalus now currently, working capital management is really important, especially from a cash, and right from the AR that I referenced, the support with EDC, and great to see Raul come off camera there and wave to the group, as well as managing inventory. And I know there's a lot of technology companies that are software only and SaaS, and my current company has the benefit and challenges of having hardware, that dirty word, and then as well as embedded software and enterprise software and analytics and AI, but it's kind of a system. So hardware is great because it puts a land grab and it really anchors your customers for a long time, a decade plus. But there's challenges, and now supply chain management issues are real, you know, as well as the talent access for IP companies, more software. So, you know, looking at managing working capital, inventory, AR, other items is very key, and George couldn't agree with you more. I think right now, we have a couple questions here that we have received and want to send those out. And please feel free to add any other customers' questions in the chat. The first one I'll say, and maybe I'll start with George and go through, is in your roles as CFOs, what are some of the lessons you have learned over the years? Was there ever a very difficult financial decision or challenging financial situation you had to work through? And what did you learn from that experience?
Good question. I mean, one of the most challenging things I've had to face is the settlement of debt, pennies on the dollar. We had a company, or I was working for a company, CFO, and we had a bunch of sub debt on our books. It was cluttering up our balance sheet, so to speak. It was making it a bit more tricky to grow the company and move forward. And I had to do a bit of a roadshow and explain to these poor investors that if they continued the way they were, the company would be insolvent and they'd get absolutely nothing. The lesson I learned is deal with them as a group. We ended up with one of them holding out right till the end, and he got the best deal, which was unfortunate. But yeah, the lesson I learned there, one, try not to get into that situation because it's not a pleasant thing to go through. But the other thing is deal with them as a group and try and get one settlement for all rather than having one guy hold the I guess a hammer over your head. So
communication and collaboration for sure.
Mm-hmm.
Yeah. Shannon or Jonathan, anything to add to that? I have a question for Shannon here from the line. So maybe I'll just jump to that because I think it's, no offense, Jonathan or George, but the question is sometimes the line between being resilient and getting married with the way to get there could be very thin. How have you distinguished that line in the past while working with startups and decided that change must be done?
That's a fantastic question. And I think it's understood in the early stage startup community that sometimes the CEO or co-founders or early stage team members are not always the same people that cross the finish line, whatever that finish line is for you. And in fact, investors and VCs on the other side, as they look at companies, they formulate that this is going to happen because they've been through it, they've seen it. So they even know that the people at certain stage don't always cross the finish line. So my advice to you would be this, is to seek out and identify those companies where there has been changed. And if you could understand the nature and why things were changed and how they handled it and what worked and what didn't work, because these are the sort of awkward stories in the community that, aren't readily available. And you should have them in your back pocket if you're building something. You only find out about these stories when you're in them. And so if you could gain knowledge about what that ecosystem of significant change, whether it's with the CEO or board members need to leave or your co-founder or C-suite, you need to understand what that looks like before you're there. It just makes your ability to make that decision clearer. So I hope I answered that for you.
No, that's some good context for sure from the trenches as well. So is to the point of what doesn't kill us makes us all stronger. Maybe on that startup theme, what would maybe someone, and Jonathan maybe take this one, is what would your advice for companies trying to increase or stretch their runway?
A good question and definitely topical right now. It's something that we've had to deal with just over the life of the company since we've been around for so long. For us, it's really about knowing all of your expenses having a good handle on it. And that's the interesting thing is a lot of like, previously I was an auditor. The number of companies that I've worked with that didn't have a good handle on what their actual cash outflows were. They knew on a macro level, or they knew on an annual or quarterly basis, but you need to be granular. You need to be like monthly, weekly, daily, like know what's going out, know what's coming in, knowing, like understanding what your receivables look like, because that makes the big difference between being able to actually invest in sales and marketing or not.
No, I think some relevant stuff, and as devil is in the details, as they say, right? So, and rolling your sleeves up past your elbows, past your shoulders, and getting in there to but what it's hard to you need to know what you're dealing with to be able to manage that. If you can't measure it, you can't manage it, which is always a challenge, right? And maybe throw this one to George to start with is, how does the favorable Canadian dollar and the US environment impact the availability of capital from the US into Canada? We've been seeing a lot of VCs, private equity firms, north, south, especially into BC. What are your thoughts of the environment and accessing maybe capital, especially as a technology company down south?
Well, I mean, tricky question. Thanks, George. And I've seen it a lot over the years in service businesses, right? If you can provide the services here in Canada to customers in the US, this kind of Canadian US dollar relationship really helps, right? Because the US companies are always trying to reduce the costs, and if they can knock 30% off their labor budget, they will. The unfortunate thing about that is that it doesn't really grow the economy of Canada. I mean, it helps for a short period of time, and then of course, if the exchange rate ever goes back to par where it was, all of that business disappears. And so we do see a fair amount of that in the services business. It's interesting. Obviously now from a US perspective, all of our great innovation in Canada, which we're renowned for, is now 30% cheaper than it was a few years ago. And sometimes that's a good thing. Sometimes, yeah, like you said, sometimes money can come up and cross the border and invest in IP and businesses and really grow the economy. Other times, a whole bunch of IP just disappears across the border and we never see it again. So, I think it's good and bad, and it depends on the situation. And hopefully that's answered the question. I'm sure Shannon and/or Jonathan can add to that.
Sure. I'll open it up if there's any further commentary. Jonathan?
Well, I think just in looking at human capital, that's one thing that I see as opening up significantly. I think there's a lot of sadness being depression about all the layoffs with Meta and with Twitter and whatnot. But I actually see that as an opportunity, especially for a growing technology company that a lot of us are in. There's a lot of strong candidates that are out there that are now able to work, and I think over COVID-19, that's shown us that we can work remotely, we can work from wherever. So we're in the process of hiring, but we're looking across North America.
Yeah, no, I think that's relevant, and and a couple of things, and you both hit on it. You can get access to global talent maybe with our more favorable immigration laws in Canada, especially areas like from Asia, from India, China, other areas, Eastern Europe and stuff, to access talent to come to Canada, and then there is a lower cost, but there's still an access to a general global, very skilled and an increasing availability of the labor market, which may help manage the increasing costs that we've all been incurring as the salaries and the tightness of the labor market we've been experiencing. But the real, one of the questions George highlighted is, is that capital from the US? Are those companies, are they building a plant, investing in a plant, or are they investing in a business? In to mirror it in the old days, it'd be like Windsor, north of the border from Detroit, they're punching hubcaps, it's less expensive, it's great to have a plant there. Well, in this day, it's more white collar, we're punching code, and lines of code as opposed to, and, the challenge is that how do you make Vancouver, Toronto, Canada into Silicon Valley North? Whereas George said, you have these ideas, the ideas get capitalized. We actually develop them and cross the chasm from, it's a business idea and to validation to scaling, and then to global player like Shopify and others, and even Lululemon in the space. Although they did buy Mira, which is a technology company, so they're part one too. So how do you get that IP to stay here and foster that, as opposed to it's an operational cost decision, which is variable, because as George said, if it goes back to par, it's could be fragile, right? So maybe with that, I'm going to just highlight and ask what our panels, I'll let Shannon go here first, is what are your predictions? And it's always challenging looking at a very hazy crystal ball, but what are your predictions in terms of, our market in BC and Canada as we close out the year and start into 2023? And what's keeping you awake? What are you excited for? What are you preparing for?
It's such a water cooler conversation for today. Yesterday, I read an article from an economist from New York, and this gentleman had indicated that the last 3 quarters was the most significant downturn that had happened in the last 40 years. Yeah. So that doesn't really sound that inspiring, but I do think there's another short term ahead of us where it is still going to continue to be stressful, depending on the nature of your company or stage or what have you. But very clearly with these times, I see opportunity. So what people need to do is sort of batten down the hatches, do what they can, because on the short other end of that, or you're going to see other challenges where things are going to switch in the other direction. So that's kind of my sense on how things are. It's a little gloomy, but there's going to be opportunity on the other side.
No, there's a light at the end of the tunnel, and it's not the train coming at you. It's the sun. The other thing I'll highlight is please look at your chat, and thanks for Shannon's highlighted a good book to read called Founder's Dilemma, which discusses changes of focus on ego versus dollars and a bunch of stuff. And so thank you, Shannon. Jonathan or George, welcome your predictions as well and thoughts on, moving forward.
Yeah, I think just kind of dovetailing on what Shannon was saying, I think patience is going to be the name of the game for 2023. You're kind of seeing it already just in terms of, if you're looking at financing, the responsiveness of the people that you're emailing is just getting longer because there's not the burning desire, burning need. There's not the FOMO right now. So people are aware that they can wait a day or two or see how things are going, because people are just going to sit on the sidelines for a while. I still think there's a lot of upside in the market. It's going to be spotty. I'm still positive on it, but it's going to be a patient game.
No, good thoughts. And finally, George.
Yeah, like I was saying, I think we're seeing some less uncertainty in the Canadian market. It's going to be interesting to see what the results of the midterms in the US is going to bring. If you're in Europe, help. I don't know where you're going to find help. I think Europe is a bit of a mess, and it's going to be a bit of a mess for a while. And yeah, I think there are other parts of the world that you want to stay out of. I think North America is probably the best place to be right now, and especially Canada.
Yeah, it's amazing how regionally focused we've become, and self-sufficient we need to be. So, well, first of all, I really want to thank Shannon, Jonathan, and George. I mean, fabulous discussion, good insights, and from our CFO Council, we meet, and really the mandate is it's a very collaborative and supportive group to address this together. So feel free to reach out to myself through BC Tech and my colleagues, and candidly, the stronger that we support each other, the stronger we make our economy, and the more really good companies we have in our backyard that prosper and grow, the better we have. And I know Erica's just put something in the chat, but let's make this Silicon Valley North, and there's peaks and valleys, but survive the peaks and enjoy the times on the top, and there we go. And once again, be proactive. There's lots of great people, partners, some on the call, on the session here with Dean at RBC and Raul at EDC and others, and talk to them early, foster those relationships, as we're all here wanting to build a great community and economy and companies in our backyard. So wish everyone all the best. And it's not easy rubbing nickels to get quarters, but good luck in the process.